One question I get asked a lot is, where can I invest my money? This is a very beautiful question. I'm sure you may have asked it before. But the thing is, this question is supposed to come after the question, how can I invest my money? Many people are falling victim of bad investment opportunities, Ponzi schemes, pyramid schemes, name it. All of those opportunities that took away your capital or the capital of your friends and family members but never returned it back to them. And that's because they didn't know the how to invest before looking for a place to invest their money. In this video, I will share with you how to invest as a beginner. Hi, my name is Okolocha. I'm a personal finance evangelist, and on this YouTube channel, I talk about money, investing, business, economics, and everything that pertains to how best you can use the income you earn today to create transgenerational wealth. If you just found this YouTube channel, please hit the subscribe button so you don't miss out from the next valuable video like this. Before we start talking about how you can start investing as a beginner, let's first define what investing means. Investing is simply putting aside a sum of money into an asset or an investment opportunity that has a potential to grow in value over time. A typical example is buying a plot of land today for ₦1 million and in the next 5 years appreciates in price to say 5 million or 10 million naira. Now that growth in value from 1 million naira to say 5 million or 10 million naira is what makes that investment profitable. So when looking out for investing, we're always having our eyes on profitability of that opportunity over time. Now, why should you invest? First off, leaving money in your bank account is a losing game because inflation is going to reduce its value with time. In a country like Nigeria, where inflation is as high as 23% per annum, if you have ₦1 million saved today, it means that this time next year, the value is going to reduce by 20%. So your ₦1 million will now be worth 800,000 naira when you take it to the market to buy anything. So this is why you should stop leaving your money in your bank account. Instead, invest. When you invest, the return on investment helps to cancel the effect of inflation on your money. Now let's talk about how you can start investing as a beginner. Number one, create an emergency fund. An emergency fund is simply an account or an amount of money that's allocated for emergencies. Emergencies like sudden loss of job, medical illness, or car accidents, or anything that was not factored into your monthly budget. An emergency fund is 3 to 6 months of your living expenses. Take for example, you spend 300,000 naira on a monthly basis. It means that you should have 900,000 to 2.4 million naira in an account that is risk-free. This should not be in your fintech apps, but in your bank account. If you're an high-income earner, I recommend that this money should be saved in dollars in your DOM account so that anytime you need this money, you can easily access it. Remember that it is for emergencies. Now, the reason why you should have an emergency fund is so that you do not liquidate your investments when you need money urgently. Some persons have had to sell their stocks at a loss lower than the price that they bought, have to sell their land at a distress sale because they needed to meet an urgent need, maybe a medical issue or to fix their car and whatnot. When you have an emergency fund, you would not find yourself in such a situation where you have to panic sell, because regardless of how terrible the market would be today, in the next 3, 4 or maybe 6 months is likely to recover. So the emergency fund helps to ensure that you're patient even when many people are becoming impatient to get out their money from the markets, whether real estate market, stock market, crypto market, or wherever it is that you have invested your money. Number two, learn before you invest. This is something that many people do not like to do. So when we say come for stocks investment class, crypto class, mutual funds class, how to buy bonds, come and learn how to do these things from the very fundamentals. Not many people are interested. And this is why they go for the part that they think that is easy or it's not complex, which is investing in Ponzi schemes, and they end up losing their money in the process. See, investing is not as complex as you think. I mean, investing in legitimate opportunities like bonds, treasury bills, stocks, crypto, real estate, and every other legitimate opportunity out there. They are very, very easy to understand. You just need to dedicate, say, 2 to 3 hours of your time to understand the fundamentals before going ahead to invest in it. Please Do not invest in what you don't understand. No matter how juicy the opportunity sounds, no matter the testimonials you hear from your friends and your relatives about that investment opportunity, make sure you understand how the money is being made through that investment before you put your money in it. Learn about that investment. Ask questions. How is this money being made? Is it a high-risk investment opportunity? Is it a low-risk investment opportunity? When am I going to get my capital back? How am I going to get my interest? Is it going to be on a monthly basis or a quarterly basis or a yearly basis or twice a year? How exactly does this money grow in value? What does this investment house use the money to do? Ask these questions, and in asking, that's how you're going to know if this investment opportunity is worth the time, worth the money, worth the effort or not. Number 3, know your risk tolerance. Like I said earlier, every investment opportunity has a risk associated with it. It can be low risk like bonds, treasury bills, or mid risk like commercial papers, mutual funds, or high risk like stocks, crypto. So ensure you understand the type of risks you're getting into before you commit your money to it. See, there are some opportunities that you can invest today and you will get your money back in a month's time without it hurting the capital. There are some opportunities that if you invest in a month's time, your capital can be lower than at the time you invested, like stocks and crypto. Because the market is volatile, prices goes up and down. So you could invest 100,000 naira today in a particular stock, and this time next month the price of that stock would have gone down, and then the value of your investment would have dropped to say 90,000 or even less. But one thing you need to know is that if it's a good stock that you bought, that the price has fallen and the value of your investment has dropped to 90,000, does not mean that it will remain there. In a few weeks or few months from that time, it can go back up to 100,000 that it was at the initial time you bought, or even surpass it. It has happened a couple of times. So this is why you need to understand what kind of market you're investing in. Some persons have very low risk appetites. They cannot stand seeing their investments, going down in value, even though they know that it can recover back up. They just can't bear it. So if you're one of those that cannot bear seeing the capital that you invested, your hard-earned money, maybe you invested 10 million naira and it drops to 8 million naira. If you can't bear seeing a negative of 2 million, please avoid high risk investment opportunities, right? But if you are one that has a high risk tolerance, you don't mind, losing a part of your capital, or you don't mind waiting a long time for the loss to turn back into profit, then you should consider investing in high risk opportunities. Now, one thing you should know is that there's a difference between tolerance and appetite. You could have an appetite for investing in the stock market because you're young, because you earn a lot of money, because you can afford, to wait for a long time. That's good. So you invest that money, and if there's a turn down in the market, there's a bear market for an extended period of time, would you be able to survive without that money? That's what determines your risk tolerance. So even if you lose all of that capital, is it going to affect your lifestyle? Is it going to affect maybe funding your future plans and so on? So if it's not going to affect in any way, or it's going to have a very little effect on you, that means you have a very high risk tolerance. But if you're one that capital that you invested in the stock market, and during the time of the bear market, that investment is going to deprive you of paying maybe your children's school fees, or a plan to go for your MSc, or maybe because you're already in your 50s and then it's just a few years ahead of you to retire, if that's going to affect your retirement plan, that means that you have a low risk tolerance. So don't go about investing in high risk opportunities because you think you can bear the risks. No, consider the fact that that risk you're taking can deprive you from achieving other financial goals that you may have. Again, I usually recommend that the younger you are, the more risks you should take. If you're in your early 20s or your early 30s, you should have a high risk tolerance because you don't have responsibilities as much as someone that's in his 40s or 50s. Someone that's in his 40s already has children in secondary school, of which some of them are already thinking of going to university. So the living expenses for somebody in his 40s or 50s is quite high. So if you invest money, you really want that money to come back to you so that you can sort out your family expenditures. That money not coming back to you, even if it's not going to affect your immediate finances, it can impact your mental health, and that could make you make some other rash decisions that also affect your total finances. Number 4, diversify your investment portfolio. Do not put all your eggs in one basket. No matter how juicy an opportunity sounds or looks like, make sure you do not put all of your money in it. So some persons are overly invested in the crypto market, some persons are overly invested in the real estate market. Now, both markets are good to invest, but I recommend all the time that you should have a diversified portfolio. So you could have 20% in real estate, 30% in crypto, and that 30% in stocks, and maybe 10-20% in bonds, depending again on your risk tolerance. Somebody that is young, you're in your early 20s or early 30s, you should have more of your portfolio looking at the high risk part. So maybe 50% can be covering stocks and crypto, then another 50% can be looking at real estate, bonds, or mutual funds. So just ensure that you're not overly exposed to a particular asset class. The reason is so that you can minimize risks and reduce losses, and also to maximize profits. If you are overly invested in low risk asset class, that means that the potential for your portfolio to grow is going to be very limited. So also, if you are overly invested in high risk asset classes, means that the potential for you to record fatal losses is also very high. So don't be too greedy, and also don't be too fearful. Make sure you have a balanced investment portfolio. And the last but not the least is have patience. Investing is a marathon and not a sprint. It's not the day that you plant a seed that it will germinate. Some seeds can take 5 years to grow. Some seeds can take 2 years to grow. Some seeds can take 1 year. Do not go into investing with a Ponzi mentality. Most people that lose in investing are those that want to get immediate return. So they are investing $1 million today, they want to get $2 million at the end of the month. That kind of mentality would lead you into recording fatal losses back to back. If you want to build a profitable investment portfolio, if you want to succeed in investing, you must have patience. Yes, patience is a virtue that you need to have. In fact, it's a skill. Patience such that even when the market is underperforming, you do not panic sell like most people do. In fact, if the market is underperforming within a period of time, that is when you're going to buy more because you can wait it out. I've had to wait 1 year, 2 years for an asset that I bought to recover back in price. I can remember vividly in 2021 when Bitcoin fell in price from $67,000 to about $40,000 and down to $27,000 and down to about $18,000 in 2022, and in 2023 it was still below $25,000. A lot of people ran away from the market. A lot of people sold their assets and abandoned the crypto market. I didn't leave. I did not sell anything. All of the assets I had bought, I held them, and today Bitcoin now is above $80,000. This means that even if I had bought Bitcoin at $7,000 in 2021, today I'm still in profit because I waited. So guys, learn how to wait. That is how you can become profitable in investments. I hope you found this helpful. Once again, thanks for watching. Don't forget to hit the subscribe button. See you in the next one.